together. If we all stand together.
All right, we're going to talk about double materiality today. And if it's a new term or sounds foreign, it is because it's a new term and it's somewhat foreign. The concept of double materiality is born in the requirements that the EU is setting through their CSRD policy updates. I am not professing to be deep state knowledgeable about this topic, only superficially knowledgeable about its intent. And I would say it's going to take a while to fully understand how this will become visible in ESG records. So, and why is all this happening? There's two slides. One, the SEC is number one. Shareholders are asking the SEC to police and manage ESG disclosures. And Kelly Gibson, for anybody who's participated in the rulemaking process over at SEC, knows that she's been very eager to hear input. But the SEC, unlike the European Union CSRD process and policy development, the SEC will not be reviewing the legality of your statements, only whether or not you followed a framework. And I was on a call earlier this week, and I think it's important to note that GRI, the Global Reporting Initiative, released their new universal standards this week, updating some of their requirements to reflect the policy updates of the CSRD. And the reason that's important is GRI will align with CSRD for the legal requirements of around 50,000 reporting entities in Europe. But when it comes to the US, those same requirements from GRI are optional. But what's not optional is that you follow the framework. So if you've adopted GRI, you voluntarily adopted the GRI reporting process, then the expectation is that you will follow the GRI framework. There was a really great quote on the GRI update that came from Carolyn Reese, and she said, with this deployment of new policy updates, people are not left to their own invention to create the frameworks. But a guy named Patrick de Camborg, who's with EFRAG, the European Financial Reporting Group, clearly stated that the frameworks are largely inspirational, but they're not standardized. And the EU intends to see that standardization take place over the next few years. Now, double materiality, why are we here to talk about it? Refrigerants are at a very interesting crossroads here. They have a dual impact, but to state it clearly, it's right here on the screen. Materiality is often referred to as financial materiality, and that's where some global issue related to climate change has an impact on a company's operation. And it could be, like, for instance, climate change is rapidly evolving, and you're a waterfront Navy base, and you're going to lose 10% of the base. That's materiality. Double materiality is where you report on the increased demand that cooling, for instance, will lead to a higher energy demand, possibly more leaks, and you report on the double materiality issue. And there's two aspects to double materiality. One is financial, and the other one is social. Now, refrigerants, I mentioned them because I reviewed, in preparation for today, I reviewed over 300 publicly disclosed ESG filings. And in less than 50% of those filings was any mention of refrigerants. And each one of these entities was a very high GWP emitting entity. They were chosen because they had to report in 3 different areas, not just subpart DD, or not, excuse me, subpart F for EPA, but also RGGI and also GRI. And in none of those reports are, sorry, under 50% of those reports, refrigerants were mentioned. However, in each of the under 50% of the reports that did disclose, the disclosures ranged from a fraction of a pound to 100 pounds, which largely underestimates the emissions from any of these entities. Does anyone have any questions about that? I'm happy to talk about what I reviewed if it helps anybody. Okay.
I don't have any question, but I know when it comes to, I mean, I just did a similar process in food retail, and I certainly didn't review 300 ESG reports, but it was maybe like 15 or 20. And refrigerants, even from food retailers, is not really mentioned in much detail.
I ended up on the 300 because I was surprised. First of all, I got a big giant download from somebody who I asked a favor of, and then I felt obligated. It took me about 6 weeks, and so Peter, your results are kind of the ones. I mean, as I go through, jump in, but you're seeing the same thing I'm seeing. People are largely underreporting. Anybody here who's not familiar with CSRD? I mentioned it a couple times. That's the EU Corporate Sustainability Reporting Group, Reporting Policy Development Group. And as I mentioned, GRI is aligning with CSRD. GRI is voluntary outside of the EU, but in the EU, it is mandatory. If you're a reporting entity and you have obligations to report in the EU, you are likely going to want to follow the same policy in the US as well as the EU, which makes this a bigger lift. This is a much bigger challenge. But I want to get on to some examples of what double materiality actually means, because there's not many out there, but I found a few. Does anyone have any questions about the CSRD? Okay. This is actually right out of the CSRD policy book. So this is a screen capture right from them. The left side looks very similar to the materiality versus double materiality slide I shared earlier. But it's non-financial reporting directive under the CSRD is where we capture double materiality. And refrigerants have a really significant GWP. And they also have a lot of regulatory responsibilities attached to them. The left side of this chart is the 100-year, when you can see these numbers. And the right side is the 20-year. Now, we're not going to use the 20-year for most of our reporting purposes, because by treaty, everybody's using the 100-year, which is AR4. But it's important to note that the significance to the GWP significance of these materials is also what leads governments to put heavy regulations on these. And there's a significant gap between the regulatory boundaries and the reporting boundaries under GRI. So let's talk about that. There are no limits in the GRI Scope 1 emission reporting obligation. As an entity, you can decide to disclose aspects of that. So you can limit it. And you can say, we only report on 50-pound and over assets. But if you don't disclose that, then the assumption is that you're reporting all of your emissions. And in every one of those reports that I read, and let's face it, after I got through 300, only 100, roughly 150 were needed to be fully read, and they didn't even need a full dive on evaluation, because only about 30 companies reported more than 10 pounds of refrigerant emissions. So Sounds big, 300, but when you get right down to it, 30 reported just over 10 pounds of emissions. And these are really big entities. So the expectation is you're reporting scope 1 emissions. And now these scope 1 emissions are a pivot point for your disclosure of your impact. Investor grade data. I wanted to bring this up. When I did have the good fortune of talking to 2 of the companies who were on the list. And of the 2 companies that I talked to, their data was awful. And we evolved to a point in the conversation where it was decided that this needed to be investor grade data, or they didn't want to report it. And why I found that really interesting is, well, some of you are probably being creative with your own answer, but investor grade data means that this has to be verified and validated. And so if they're underreporting today, at some point, the assumption is that they're going to get better at reporting. And by then they hope their leak rates will have gone down. But most of them, at least the 2 that I talked to, struggled with the same thing. They had asset registry problems and very little governance over the data. And so once we change the way we think about the data and bump it up from mechanic grade or invoice grade data to investor grade data, we really need to follow the SASB's, which is the accounting board's process for the same process that they follow for accounting for material transactions and this materiality awareness. Underreporting is definitely undermining the integrity and the quality of data right now. One company's assumed leak rate was 1%. They went with a prescriptive model instead of performance, and that prescriptive model suggested a 1% leak rate. And the problem is they only had inventory on the large chillers, and they had no maintenance record. So the more we peeled back the layers on these reports and these operational pieces of information, the more we realized the data and the spectrum of the data was really limited. Now, materiality, for the purpose of discussion, is the financial impact, both positive and negative, from climate change. All right. I think that's easy to understand. And that's a already well-adopted accounting principle, and it's already expected that companies are reporting that way, even though the documentation shows and the evidence shows that they're not reporting that way. That's the expectation. All right. There's really very little to argue with here. The new policy is double materiality. Now, in the double materiality world, now you're going to report the social perspective of that impact. And I found a really great report by Machado, and it was written in 2020, where they evaluated, him and a small team evaluated 140 of these reports and found that the materiality assessment was unclear and not explicit. Very similar to the findings that I had. Peter, sounds like the same results that you found. But it's always nice to point to somebody who's written a report after studying it in a more scientific way than my own seat of the pants evaluation. They found that organizations had a lot of room to manipulate and prioritize the issues, and they felt like it was heavily politically prioritized. In examining the report, the 50 largest hotel groups, which were the part of the focus of this report, found a lack of experience in conducting the materiality analysis. So they found flaws all throughout the reporting spectrum. And I'm happy to share the Machado report with anybody at the end if they want it. All right, very important. The double materiality isn't going to require a whole new assessment. It just requires having some evidence and a process. And anybody who's read through GRI 305 knows that the GRI process is very broad. That's why it's more of a framework than a standard. There's really no standard when it comes to this reporting responsibility. The expectation is, though, that if it's a material issue that's going to impact stakeholders, you have to think about it from their perspective. And that's what the EU EFRAG group is looking at, as well as the SEC. If you're running a data center and it's largely R22 or R11, or even if you have a significant amount of R123, you want to keep in mind that if shareholders don't know that you have to either have accommodations in place to replace all these machines because they are becoming obsolete, or if they're not aware of the financial impact of the accelerated requirement to depreciate these assets, then that is not disclosing all of the information. The expectation is that you will disclose all that information. All right, any questions on that?
So is there any big issue when somebody transitions, not just from a single materiality standpoint, but a double? Because on one side you have a negative impact, from the other side you have a positive impact.
Yeah, it's a great point. The expectation is, let's call that the inside out principle, all right? Yeah, the impacts of the company's own operation and its value chain are expected to be reported. So it's a really timely question. And you're supposed to do it based on severity. I mean, if you look at a company's installed inventory and you're operating with 50% HCFC installed charges in all of your systems, that's a really significant vulnerability. But it's also a great opportunity to transition to a lower GWP material. And you want to talk about any of the goals that you have in making that transition. Maybe it's a goal to meet your compliance responsibilities, right? Or accelerate your compliance responsibility obligations, but also it could lead to lower energy or higher energy. The expectation is that you're going to report on that. Now imagine the complexity of this, considering it's very challenging already for companies to even find where their value chain or their infrastructural chain has installed capacity. Most people don't even know. So all of a sudden, now you're left with the responsibility of reporting this benefit or detriment or harm or positive or negative, but you don't even know what it is already. Does that answer that question?
It helps, for sure.
This is a journey. I don't have all the answers. I can just tell you this. In everything that everyone's reading, and remember, I'm not the only one reading it. The SEC's reading it, EFRAG's reading it, GRI's reading this. These studies are being put out into the marketplace frequently now about the vulnerability in the materiality transaction process. So everyone knows there's a vulnerability here. At some point, somebody is going to feel the sting from that let's call it improper reporting process, and it's going to hurt shareholder value. It's going to undermine trust, and that's really what this is all about. The SEC and EFRAG are really stepping in aggressively because shareholder trust is undermined by the invention or people's own invention of their own ESG report boundaries. All right.
So coming out of left field here, would a blockchain process for that transition be of any benefit? Your opinion?
Sure. Yeah, it sure would. I mean, for instance, Trakref is built on a blockchain, but that's not our biggest problem. The biggest problem is in disclosing the information that you collect and setting the boundary lines out far enough.
Gotcha.
I'll give you a great example. Let's say you're a major equipment manufacturer, hypothetically, and you're responsible for managing all the large systems on site, but not the small systems. What ends up happening is you might do a great job at disclosing the large system emission rate and the large system transactions, and you don't capture the small systems. It's not because you don't want to. but it's not under your purview or your responsibility. So we see this happen all the time. We have clients that have, let's say, 50,000 assets, but they only report on 5,000 of those assets. Their largest emissions may not be from those 5,000 because they've put a lot of attention on those 5,000, but not the other 45,000 that they don't track anything against. So I came up with a couple of scenarios, and this scenario is up in front of you. The expectation is the box on the left is what you're reporting. Now, I don't think many people are reporting that climate change has led to, an increase in energy demand, an increase in maintenance, requirement that we accelerate the depreciation because the systems are running further into the extreme hour range, and we have an increased leak rate. But that's the expectation. So that's the first vulnerability in these ESG disclosures. And for instance, one of the companies had reported 1,000, this example comes right from this company, had reported a leak rate internally of 1,000 pounds of 404. But when the reporting team saw the 984,000 pounds of related CO2, they decided that they would make an adjustment to that number to roughly 9,000 because they thought the operations people must be wrong. So now the box on the right is what is expected to be documented from the social perspective. Our maintenance program hasn't transitioned to proactive repairs, so we're going to continue to have a high leak rate, and this is obstructing our path to net zero. I haven't seen anything close to this. But essentially, it's been established that climate-related temperature rise is leading to further increases in the cooling demand. One report done recently in Science that was published in Science Daily published data from Nest building information that they were given in Switzerland. And it was fascinating to see the increase in energy. The number that they anticipate was 23% increase in building energy consumption. I was fascinated by that number. I don't know if anyone else is, but that just about threw me back on my heels. All right. So essentially, guys, compliance is out of sync with sustainability. Sustainability teams that are relying on compliance data for their reporting or record keeping are relying heavily on a boundary line that may only be set at 50 pounds. It may be set at a higher number. One of the companies only disclosed their large chiller numbers in their report, and they were brand new, so there was no leak rates. And also, in this one situation of the two people that I talked to, the contract they had with their vendor, since they weren't paying for refrigerant, they weren't getting any view of any refrigerant added to the chiller during that warranty period. So that wasn't disclosed, though, to the sustainability people in the report. And even internally, it wasn't disclosed. Does anyone have any questions about that? That's a really powerful one. I have another example.
Ted, in your opinion, in 5 years in the perfect world, who takes the lead in generating the standardization of sustainability reporting for Fortune 500 companies?
I'm 100% certain of the following statement. CFOs are driving the change, and they are the ones who are signing the documents. It is no longer the operational people who are going to be responsible for creating the framework for the documentation. It's the CFOs. And I have zero doubt to that. In every one of the meetings I'm participating in, there are no other group, no other people involved other than CFOs and lawyers. People's legal teams are there and their CFOs in every meeting. And I'm fascinated at this evolution because even though for more than 2 decades, we've had these regulatory requirements for awareness on what limits are in place for leak rates or how reporting is supposed to take place. Nothing has been done at this level. But now that FRAG and the SEC have put their eyes on it, just in the last 5 weeks, it's been meeting after meeting with CFOs. I went to a small sustainability discussion. It was 50% CFOs, which really surprised me. And there are a bunch of these meetings coming up, and they're meetings that I would historically have loved to attended, but not felt like I had the time. But now we have to attend those meetings, because with the CFOs following the standard accounting, the whatever it's called, the SASB, whatever that stands for, the Accounting Standards Board, they are establishing the what's the right word I want to use? I was told what to use. They're establishing the standards, and the GRIs of the world are establishing the frameworks. So SASB is very active in this process right now. All right. You have to go beyond the invoice. Invoices are not capturing the information. And I had one client hand us a whole bunch of invoices and say, tell me what you think. And I could not get an emissions rate from their invoices. They might have been billed for refrigerant, but it didn't give me a total weight. It just gave us a dollar amount. $642 added refrigerant. $1,800 added refrigerant. One bill, $13,000 added refrigerant. And nowhere in there did I know what the total amount of refrigerant was. And when I called the service companies back that had done the work, sometimes they could put their finger on a weight. Sometimes they said they didn't have the weight. They just knew that it was at least one full cylinder. And so this journey didn't improve the data as I dug down deeper into the workforce. It made it even more frustrating. So we've got to think beyond the invoice. The invoice isn't doing it for this audience anymore. Now, it's important, obviously, because shareholders are asking for this data. And these ESG records are being requested by banks, financial institutions. It's no longer just whether your shareholders like your sales slip that you handed them. It's about your bank who's looking through these records. And I've got two great examples that I found, and I want to share those at the very end. I guess we can say this is kind of the very end, because I only have one more slide, and it's really not that significant, except this was a quote by Patrick de Camborg. He's with FRAG, and he said specifically on the GRI call on Monday, double materiality reporting is the goal. Another gentleman who was on the call named Jyrki Reina said it is no longer acceptable for organizations to focus on shareholder wealth. That now the expectation is they have to demonstrate a force for positive change in the economy. And this is the group of people who are drafting, nurturing, and approving the policy adjustments in the EU. These are the people that are setting the policies in place that the frameworks will support, and the SASB will deliver policy guidance for, that CFOs read and then push down through their organization. So I'm going to stop sharing, but I'm happy to go back. I'm going to pull up two examples that help shed some light on this. Number one, a tobacco industry. So I was able to find some results. So everyone knows that tobacco's had adverse effects on public health for at least 20 years. But when investors and society knew that there were negative effects from tobacco in the cigarette industry, we could not see that in the financial materiality. We noticed that the broad market returns over the last 20 years from MSCI World were about 212%, okay? But the returns in the tobacco industry over those 20 years were 592%. So at first glance, the sustainable materiality didn't seem to correspond to the financial materiality. because we knew that there was a social impact. Well, the value on the tobacco companies rose over that 20-year period. So it seemed like the negative impacts from the tobacco industry weren't reflected. But when you look at the next level down and you go to the 5-year materiality impact, what we found is the MSCI world was at a 90% return, which was much better than the tobacco industry's, the MSCI tobacco world return, which was negative 8%. And so the laws and regulations on tobacco, as they were tightened in that period, with the result that the sustainable materiality impact and financial materiality were a lot more closely connected in the 5-year period than they were the 20-year period. So the concept here, the suggestion is that by implementing double materiality in practice earlier, will give shareholders an advanced view of 10 to 15 years out in a company's life cycle health. Now, refrigerants are a unique animal in this world because technically we're supposed to be reporting Scope 1 emissions. And so for 27 years, we have not been reporting Scope 1 emissions on refrigerants very well. But as these new processes come in from the SASB, FRAG, CSRD, and GRI, and more oversight comes to this industry, now it's no longer going to be acceptable to create prescriptive visibility, like estimate your leak rate at 1%. The expectation is now you have to use more performance-based analysis, which you have to get your data from operations. And since it's already been established and well understood and heavily documented through all of these frameworks and all of these policies, that there is no trust in the material knowledge that a company has, now the expectation is that third parties will have greater input to capturing this data and reviewing these records. All right. If no one's got any questions, I'm going to give the nitrous oxide example that I wrote up this morning. From an impact materiality perspective, nitrous oxide from fuel combustion can be a material negative impact and has harm to sustainable development of any organization. Stakeholders' interest in this perspective included NGOs, civil society, local communities, and governments setting public policy goals, and investors. Okay, investors that were focused on impact strategies or required to report on the sustainability impacts of their investment portfolios. And that was both in the EU and in the US. From a financial materiality perspective, NOx emissions had a direct monetary impact due to expenses related to emissions and controls and possible violations of air pollution regulations. Investors and capital providers and stakeholders interested in this perspective, although it can be argued that employees in society at large have an interest in knowing about the impacts. But these financial impacts were not always translated as giving visibility to the more or less efficient entities in the marketplace. So if you were running a coal plant, maybe your NOx emissions were high, but you offset it with lower cost of hydrocarbon production. And so from a shareholder perspective, at first, it looks like your coal plant's highly efficient, financially at least. But natural gas may seem to come in at a higher cost, but or even nuclear, it could be argued, and nuclear has been argued heavily in this case. However, your long-term benefits of making an investment as a shareholder have less risk because you're not as impacted by the NOx emissions challenges from the plant's operation. Chase, how did I do for an example on NOx and SOx? I thought I'd throw that out there for you.
Yeah, it's good. It's relatable, clear as mud.
Well, this is so new. This concept is so difficult to consume and report on that everything you read says we're going to have challenges operationally to report. I'll be proud to tell everybody here that's not a case in the refrigerant world. In the refrigerant world, we know operationally from a performance perspective what's happening. This is not a mystery. And in many cases, once you put these controls in place or data capture controls in place, you also find that your narrative changes. So we're the unicorn in this industry. We know exactly what's happening. Paul, would you agree to that?
Totally.
So
100%.
what did you think, Paul? Is this double materiality interesting, scary, positive?
No, extremely interesting. We've had a couple real high level discussions about it, kind of feeling out, how we can implement certain things to bring value to that, not just as a company, but to our customers as well. So yeah, there's a lot to take in here, a lot to digest, and man, a lot of information. So thank you so much.
I was nervous 6 weeks ago when I started really diving into the double materiality concept. It was because I realized that it was a little risky to talk about it because everyone's aware of it, but no one wants to get up and talk about it in the private sector yet. So,
right.
I decided,
and to be ahead of it, by leaps and bounds is way better than to start from behind. So.
Yeah, well, I feel intimidated by the topic because we haven't had to help anybody report a double materiality issue yet in their ESG filings, but we know that's next. And so
that's coming real soon.
For all of us, right? I mean, for you as well.
Oh,
and
yeah.
How soon is it coming?
Well, in 2023, it has to be reported for Europe.
Yeah.
Which means 2022 is your year to start getting your data and your information together.
Okay.
So
It'll
it's
be deep in a year from now.
Well, let me tell you, we're working with some clients that their asset registries are 2 years away from being complete. And these are not small institutions. These are big guys. These are giant entities that are just handcuffed with bad information. I hate to make it sound terrible because I just did, but
Don't you think a challenge is that CFOs from college on have used a standard guidebook, whether it was tax law, whether it's accounting standards, and have learned to implement standards, and these standards don't exist for this sustainability reporting, right? So when I say clear as mud, I mean, I was joking, but at the same time, it is. How far am I responsible? Am I down to every unit that's hermetically sealed that has 3 pounds, or does it stop at 50? I don't know. The lack of structure for people who thrive on structure will be difficult.
Well, I'm going to read out something that I was on an SASB board discussion about 2 weeks ago. And this person from the SASB came on and said, okay, there are 8 steps in the accounting process, from identifying a transaction, recording a transaction, posting a transaction, posting the unadjusted trial balance, the worksheet that goes with the unadjusted trial balance, the adjusted journal entries, the statements, and closing the books. There are 8 steps in that process. Okay, 8. Sorry, right there. 8. And in that, he said, in order for materiality reporting to be accurate in the ESG space, we'll need to adopt the standard, the process of going through those 8 steps. So the SASB, which was hosting this discussion, was talking about those 8 steps as implementing those over time. So what the world has established, it seems like they've established, and I could be wrong, is that these steps are going to be deployed, the same ones that are used in normal financial accounting. Some version of that is going to be deployed into the materiality world. You're going to hear this, not just from me, you're going to hear it everywhere. Materiality, what's your materiality process? How qualified is your materiality audit? You're going to have a lot of discussion around materiality. And if your materiality boundary is set at your compliance boundary, it's not going to be good enough. And Chase, you asked the question, do I go down to 3 ounces? Well, if you have 8,000 3-ounce devices, then the answer is yes. If you have 10 3-ounce devices, probably not. And what we're finding is it's all going to be paralleling your operational success. What we find, and this is a little bit off topic, but trust me, I think it's relevant. What we found is the maturity of your maintenance program will dictate the maturity of your reporting process. So if 100% of your repairs are based, or 100% of your maintenance budget is based on just fixing what's broken, you're probably not going to have a really good materiality process. The higher evolved companies, and there are lots of them, but they only represent about 3% of the industry. This is a report that was done by Oxford, and I talked about it in the last open mic, but Oxford and Accenture had done a report, and they determined that near 3% of all companies had a mature, evolved maintenance cycle. And so what that means is 97% of companies that are out there, and that's Fortune 500, Fortune 1000, Fortune 50 companies are not on that, a part of that 3% that have fully evolved or mature maintenance practices. And what that means is less than 10% of your repairs are driven by failure. So, and there's a lot more conditions to that, but I found it fascinating. Anyways, any other questions?
You think the HFC phase down will accelerate this in a year and a half?
It'll make it even more confusing, I think, at first. Companies are looking at that bottom line, in my opinion. They're saying, I've got 18 more years left of depreciation on this asset. I've got 13 more years of depreciation. I got 9 more years. And they're going to hold that depreciation in place unless they can accelerate the depreciation and rationalize a conversion to something better. And that's the only time we seem to get good data, is when they change out assets. And Paul, in your world, these larger systems may not be as affected because they're more likely to get changed out. But to what Chase mentioned earlier about these smaller fleets of equipment, lots of companies have gone downsize and put out huge fleets of 5-ton, 10-ton, 20-ton units that have under 50 pounds that they don't even have a register for. Our team just looked over the records of over 1 million lines of assets, and not one record contained a useful piece of information so that we could track their refrigerant. They didn't know the refrigerant. They didn't know the quantity of refrigerant. They didn't know an install date. They didn't even know if the assets were active. It was just a data dump from their asset management system. It's depressing. But the good news is, with these processes going into place, this isn't complicated work. It's just time consuming. All right.
Ted, maybe very briefly, we're running a little bit out of time, but can you just really nuts and bolts first steps we could take?
First step, get your asset registry together. Second step, find a partner, a long-term partner, a partner that can walk with you on the journey. It's a journey. Like I said, we have clients that have been with us for 2 years, and just the first 2 years were spent just getting their processes adjusted internally. So you want to find someone that you're not getting nickeled and dimed and dinged. It's going to be a journey that you need a good, friendly set of give and take, and have a little bit of a sense of humor at first, because you're not going to believe how much work there is to do until you get in and start doing it. Does that sound positive or negative, by the way?
No, that's very positive.
Okay, good. Good. Well, I appreciate everybody joining. I know it was a little bit of a risky topic, to go through something that's so new on double materiality, but think of this as one of many things. And here at Trakref, we're not afraid to get out there and make that mistake as long as we continue to learn from it and evolve. And it also helps us do a lot of research. Usually at the end of these calls, I get a lot of emails. This wasn't our largest attended group, but considering how sausagey and technical this is, I'd say anybody that joined, my hat's off to you for listening. Yeah, and I'm wide open to listening. If someone has anything they want to share on the topic or discuss, I've had daily discussions on this topic, and I've been lucky to be able to do that. But I've been seeking out these double materiality discussions now for weeks, and I'm fascinated at how quiet and nervous people are to talk about it. And it made me a little anxious because yesterday I was on a talk and it was with a big company, and they did not want to discuss double materiality, although the whole entire discussion was around double materiality. So they didn't have any reference point. But I did find some investment bankers who helped me with the topic. So like I said, I poke around long enough. I'm lucky to find people that are willing to share their opinions and thoughts. So, and then we'll keep doing that ourselves. All right.
Thanks so much, everyone.
Yeah, thank you. Nice to see everybody.
Thank you, Ted.
Bye, guys. Bye, Paul. Nice talking to you.
Oh, good to see you too, brother.
We need to catch up someday.
Yes, very much so.
All right. Well, good luck. Bye.
Thank you. Take care.
So how's about we talk about those HFCs? Just read the facts if you don't believe me. Watch your leakage, disposal and recycle, it's key. Cause we can do this together if we all stand together.